Thank you very much, Mr. Chairman. And I want to begin my remarks by kind of setting how I view the process we're going through right now. In the debate we are having in the Congress right now over health care, I believe we are considering changes to our country that are potentially the most significant changes that I will ever see as a member of Congress. They're certainly the most significant types of changes and impacts on our country that I've seen so far in my service here. I have a hard time actually even describing how comprehensive I believe the change in America will be if we adopt that legislation that is now put forward. I have a similar feeling about the legislation that we are dealing with in terms of the financial regulatory system. The legislation that we are talking about here today, whether it be your proposed discussion draft or simply the broader issue of the concepts that are before us with regard to proposals for regulatory restructure of our financial world or our financial system in our country, are so broad that they will literally change America, depending on what we do, and in very major ways. As the Chairman knows, I've been concerned for long before we had the credit crunch and the credit crisis. I've been very concerned about the need for financial regulatory reform in our country. In fact, when we were in the majority, I was the chairman of the subcommittee that brought forward the last major financial regulatory reform bill that we handled, on which you and I worked very closely together. I've been very concerned, even before the credit crunch and the crises that we faced in the last year or two, about America's competitiveness in capital markets globally, and what the policies of the United States government were doing with regard to making us more or less competitive, and have been the chairman for a number of years of the Republican task force on capital markets. There are very serious issues that we face in addition to those that were brought to our attention as a result of the credit crisis and the mortgage crisis and the other economic concerns that have come up in just the last 10 to 20 months. And so I completely agree that we need to be working aggressively and in a focused way on making sure that our financial regulatory system in America makes us the most competitive nation that we can be. That's what will be best for us and our consumer and our constituents, the consumers in our country. That makes America the cutting edge and the leading nation in terms of world financial markets. Right. And I recognize that there are other markets that are today emerging that in past years simply did not have the capacity to be strong competitors in capital markets, and that we now see, whether it be in London and in Europe or in Shanghai or India and other places, we are seeing the development of very strong, aggressive competitors for our business. And in addition to the focus that we need to have on the immediate crisis that America is facing with regard to our credit system, and with regard to the financial regulatory structure that we have, I think we need to have an equally strong focus on America's competitive nature in capital markets. We need to focus on those kinds of issues that will make us strong. And in that regard, I have strong concerns about the legislation that has been brought forward, because as I see it, we have a proposal that will, about a 1,200-page proposal that creates 3 new agencies and fundamentally alters the way that capital is organized and accessed in the United States, and will have major impacts on our economy, on job creation, and on the cost of capital, on innovation, and on entrepreneurship. And we simply have to get it right. This, if you can even capture it, this is far bigger than just the mortgage crisis and the credit crisis that we are going through today. And we must give it the attention and the fairness and the process that it needs to get it right. There are a number of concerns that my colleagues have already raised with the bill. I won't go into them in detail, but I will discuss some of them. For example, I think perhaps the core for the immediate need that we are focused on is developing the resolution authority in the right way. and making sure that we develop a resolution authority that does not institutionalize too big to fail. While we all in Congress agree that we need to end too big to fail, we've been very careful, we have to be very careful that by setting up a formal mechanism to handle non-bank failures as well as bank failures instead of using the current bankruptcy process, that we're not increasing moral hazard by expanding the safety net and the role of the federal government in the economy. Because certain companies were not allowed to fail, the moral hazard problem that we face in this country has gotten worse. It's going to be very difficult to repair this credibility. And when push comes to shove, the government has shown so far that it doesn't get it, from my perspective. As I understand the language in the bill, the authority that will be granted to the resolution authority in the process is extremely broad. It could be used for institutions very broadly across this country, as widely as from General Motors and Chrysler to CIT and any number of other circumstances that we've already seen faced in our country. But again, as I understand the proposal, once the government acts, there is no limit. There is no limit on the amount of funding that can be provided, and there is no requirement that the institution must be liquidated. What that means is that we will literally be creating a circumstance in which we increase the potential for U.S. government and taxpayer interventions in the private sector when a company is failing, with no limit to what the federal taxpayer can be asked to provide, and no requirement that there will be a liquidation of the failing company. That, I believe, is a mistake, a huge mistake in development of a resolution authority. Once creditors realize that the government still has this broad authority, there will be an increased hazard that there will be a rush to become those that are too big to fail, to become those that have the implicit government guarantee, because those companies will then have an additional advantage in the marketplace with that implicit government guarantee. And we must be careful to avoid that. One of the priorities of this legislation should be to reestablish the principle that we have a market that will allow companies to fail. Now, I recognize that we need to have a process in place so that we can avoid some of the very difficult and dangerous consequences of a large institution failing. And we need to be able to provide a way to, just as our bankruptcy courts do in many other contexts today, to allow that transition to occur. But we need to make sure that we allow that, not only allow, but require that that transition occurs when a company is failing. Otherwise, we will continue to see circumstances like we saw with Fannie Mae and Freddie Mac, which, by the way, I also believe we fail to deal with in the legislation and should. And we will see basically a continuation of the concerns that many of us, I think, share now with TARP. I believe we should act on how to handle and resolve TARP in this legislation as well. Let me shift for a minute to the consumer protection issues. With regard to consumer protection, I am one of those who believes that it is a mistake to sever consumer protection from prudential regulation. It's clear that the practices in our financial markets and failures in our regulatory system played key roles in both sparking the crisis and magnifying its severity. And in my opinion, we need to strengthen the link between and the coordination between prudential supervision and consumer protection, rather than severing it. The scope of this issue also is broad, and it could be one of those circumstances in which, as Senator Gregg indicated, the unintended consequence, if we get this wrong, could be that we will actually cause a restriction of access to credit to consumers across this country at the very time when they need to have a better ability to access that credit in ways that are safe and sound. I do also agree that we want to make sure that we protect our dual banking system, and I'm concerned about some of the provisions that Senator Shelby has raised with regard to the question of whether our dual banking system will be preserved adequately in the legislation. And Mr. Chairman, I've got a number of others here on derivatives. We haven't had a lot of talk about derivatives here today, but that's obviously one of the key issues that we're going to need to deal with. I'm concerned that by creating this new regulatory structure that we see, we will have unclear effects that create burdensome and duplicative requirements for financial institutions and end users of derivatives under a framework that would be administered by two separate agencies that are traditionally at odds with each other on many occasions. And if we're not careful, we'll be responsible for creating a disincentive in financial markets in this country to work and significantly increase financing and hedge costs in business for end users. We would, in that case, be likely chasing business overseas and imposing tremendous liquidity strains on financial institutions and market participants, increasing, or I should say reducing, our competitiveness in capital markets globally. There are a number of others. I'm going to move to a conclusion at this point, Mr. Chairman, but I think the fact that we have that this is so important and that we have so many major issues on the table here that we need to get right requires us to have a process where we work through it and we take the time to work through it. I believe that we can find common ground on a tremendous number of these issue areas. I think that this issue actually is different than the health care debate, where it's been extremely difficult for us to find common ground between the two parties. In this one, although there will be some big divisions, there are also going to be a number of areas, in fact, maybe the majority of the areas, where we can find the ability to work forward in ways that we will all have confidence in as we do this. Confidence that we've got it right and that we are actually helping to restore America's competitiveness globally. Done properly, reform will increase consumer protection and prudential protection. It will enhance our ability to manage systemic risk and end the too-big-to-fail hazard or risk in the United States, and facilitate capital formation processes that are so necessary for job creation and American competitiveness. And that's what I think we ought to set as our ultimate objective here. I'm very concerned, as Senator Corker indicated, that the deadlines we're facing right now for development of amendments is just unachievable. I mean, there are so many complicated corrections and discussions that need to be held with regard to the current discussion draft, that to have the specific amendment language ready within just less than a week or about a half a week is just too short a time. And so I encourage the Chairman, as you have done throughout this process, to work with us closely and to provide the flexibility for us to find that common ground where we can come together and solve one of the problems that, like I said at the outset of my remarks, I consider to be as important as the health care debate in this country with regard to the future of our nation. Thank you, Mr. Chairman.